Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and today I'm speaking with Kevin Simpson, who's the founder and chief investment officer of Capital Wealth Planning out of Naples, Florida. I've never had a subject matter expert come on this show before that has the knowledge that Kevin has around covered call strategies. And given the market environment we're in today, it's applicable, but it's also applicable for all market environments. Kevin, thanks so much for coming on.
Thanks, Jay. Thanks for having me.
All right. In our pre-interview call, you and I debated whether we should start with a question around what is a covered call. And I kind of decided that the sophistication level of this audience, that would just be a little bit too simple. But Kevin, I think I've changed my mind. And here's why. I write covered calls in my portfolios. My wife asked who was coming on the show today. I explained to her what covered calls were, and she looked at me like I had three heads. Clearly, we need to start with what is a covered call and how do you explain it to folks?
Sure. I love how we're going off script. This is excellent. The first thing that I think about when we teach covered calls is the idea of an analogy of rental income. And I think that starts at a base level that most people can understand. And this is great for financial advisors who are very versed in the subject, because like you and I, who utilize covered calls in our own portfolios, being able to sometimes explain that to another person is a little bit of a challenge.
That's right.
So I always start with a real estate analogy, and I say, we buy and invest in real estate just as we do in the stock market. If we purchase a condominium here in Naples for an investment property, we do so with the hope and intent of someday selling it at a profit. Just like if we buy a share of Microsoft, we want to someday sell it at a price higher than we paid for it. The difference with real estate is that very frequently we put a tenant in place and we've got someone who's generating a nice passive cash flow where we're getting a rent check every month. Now, granted, Microsoft pays us a quarterly dividend, so there's passive income on both sides of the ledger. But in real estate, another very common engagement is if a tenant is interested in the property beyond just becoming a temporary resident. There is a lease option that's very prevalent in the real estate market where someone will pay a non-refundable deposit to lock in a price of a piece of real estate for a point in time in the future higher than the market is today. That lease option that they pay the landlord is money that the landlord's going to keep whether the real estate market goes up, down, or sideways. Same thing with the covered call is it's a lease option to buy where we're selling someone the right to buy our security at a price higher than it is today at some point in the future. And in both instances, we keep that cash flow no matter what happens. Now, the strategy works very, very well if asset prices stay level or increase modestly. If they increase at a very rapid rate, then we will acknowledge the fact that in both instances, we're going to make a profit that we were happy with at the time, the lease option premium that they paid us, but that locked in profit is going to be lower than the prevailing market rates. So if we own Microsoft and it's $100 a share and we sell someone the right to buy it from us in a month at $105, that sounds great today. It's a 5% profit over a 30-day period. That annualizes out to a 60% annualized gain, which is pretty great. You get the premium and you get whatever dividends you're entitled to. If Microsoft goes to $104 a share, well, that's kind of the perfect scenario because we had that upside appreciation, but the stock wasn't exercised. If Microsoft goes to 110, well, we captured a good return, but not all of the unrealized profit. So when I talk about covered call writing, I think that the real estate analogy, Jay, is probably the best one that I can come up with.
Yeah, I love it. That's the best analogy I've ever heard for covered calls. And very simple to explain to the end client and put them in the frame of mind to be able to then understand the process that you're going to use for their assets if you're using a covered call strategy. So let's keep this high level here for a minute and talk about today's environment. And we're recording this in April of 2020. How can covered calls help in this environment? And Kevin, this is important through the lens of a financial advisor who's building portfolios.
Yeah, and I think this is the perfect time to be having this conversation because in our firm, we only work with financial advisors. So to us, that's our audience. And having gone through a 9 or 10 or 11-year bull market since whether you begin it in '08 or '09, the covered call itself, it's a great vehicle. I think there's tremendous application in rising markets. But let's face it, it works a whole lot better when markets are volatile. So I think you timed this podcast perfectly, Jay. Thank you. In volatile markets like we're in, we're seeing tremendous volatility as measured by the VIX at kind of the broadest level. And recently the VIX got up as high as 80 and change. And we hadn't seen that level of volatility since the probably end of 2008, maybe squeaking a little bit into Q1 of 2009. But options are priced on a model called the Black-Scholes model, which can look very complicated, but is really simple. It's just 3 variables: time, price, and volatility. Well, the time we can select on our own. In our space, we usually go 30 days. The price we can select on our own, 5%, 6%, 7% higher. The only component we have no control over is the volatility. But when volatility is higher, then the premiums that we generate are also higher. So I would suggest that covered calls work best when we need them to most. And that's not unique to our strategy or our firm. When we're writing covered calls, we generate the greatest premium at the period of highest volatility.
So Kevin, I always go off script in my interviews. I probably should have told you that on the front end. Here's where I'd like to go with that. So if you're an advisor listening today or in the future, and you remember the Black-Scholes model from studying for your licensing exam, maybe from some of your credentialing exams, but you hated it because you had to learn all this stuff for the test, but you want to brush up on it now. You want to get a deeper understanding. What are some of the better resources in the marketplace to get a better understanding? And maybe it's a book on covered call pricing or option.
Well, I have the Black-Scholes model, Jay, tattooed on my back. Do you think the audit would it come backwards if I show it?
Hey, I'm all about ratings. I think that would really increase our ratings for this episode.
I should have read the script, right? Who knows if we go off it? It's a great question, and again, thinking of Black-Scholes model and keeping it simple, it's really just those 3 variables. But the resource that I recommend is the CBOE website, the Chicago Board of Options Exchange, also the OIC website. These are 2 amazing resources for educational content on options at any level, for the person starting out looking at a conservative covered call approach, or someone who wants to get extremely involved in much more detailed and high-level option trades. CBOE and OIC.com are the 2 go-to resources. They're the best content, they're the freshest, and they're constantly updating all kinds of information that we find very, very valuable at our firm.
All right. So, Kevin, as someone who consults with financial advisors, I would never encourage them to go and learn about it and start implementing the strategies without a significant amount of research. In fact, my recommendation would usually be to outsource it. And we want to get into some of your process and what you do at your firm. But let's talk about first the risks associated with covered call writing, should one of my listeners decide that they're going to go do this on their own.
Yeah, and like anything, investments have risk. Option strategies can run the gambit from a risk perspective. I think covered call writing is arguably on the lower end of the risk spectrum, but it still has risk. We talk about this idea that it's a cash flow component, that you're selling into volatility to generate income, and that's a great thing. You do generate that modest level of cash flow, but all things being equal, if we're writing a covered call on an investment, our risk is associated with the investment that we own primarily, but both of which can decrease in value. Covered calls present another second unique risk to an investment holding that is, sometimes a bit frustrating because it caps your upside. So there's no free lunch in option writing. Whenever we're engaged in a strategy, we realize that we're going to exit a position at a point below its ultimate highest level. They're going to exercise, they're going to call the investment because it's in their best interest to do so. They're calling it a price lower than the prevailing market. So to think about the risks, it's not just the investment that we own and the downside that even a non-covered call engagement would have, but the forfeiture of the upside is a risk in investing when utilizing covered calls, and perhaps its greatest criticism.
Well, so for an advisor that was going to outsource a covered call writing strategy, which type of clients, in your experience, are best suited for that type of strategy?
Outsourcing option strategies, especially covered call writing, it makes sense not from the standpoint that an advisor can't write options or covered calls, because I contend that I could teach anyone to be very, very effective option strategists, traders. The problem, the downside is that some people also like to have a life, and it's a very, very time consuming process. I'm not a rocket scientist. I'm not Elon Musk. I'm not building the rocket to go to Mars. But we have an amazing team of really, really smart people who are very good at math. But it's also a process. With anything, you need to do it repetitively all the time. And sometimes, and not to accuse you of this, Jay, but there could be instances in which maybe you wrote some covered calls and you kind of got away from it and you're doing something else, and maybe you come back to it. It's a strategy, and I believe with all investments that you need to have your process, and you need to stick to it for forever. But outsourcing covered calls, I think, is more of a time saver than anything else. And there's a bunch of us who are very, very reclusive and sit at home or in our offices and do this all day long. But outsourcing it, I think, is for time management for financial advisors more so than intellectual capital.
So as part of my consulting practice, I help advisors with their model portfolios. And so they'll bring ideas from time to time on things that they think have a unique strategy. And I keep getting these closed-end funds where they're writing covered call strategies. And I keep getting still in the marketplace. I don't understand them. They can't explain it to me. So it does not need to be in an investment portfolio, in my opinion. What's your take on those closed-end funds that are writing covered call strategies?
Well, I was raised never to say anything bad about anybody. So rather than answering your question as honestly and all the thoughts that will resonate in my brain right now, I would say this. A closed-end fund it lacks transparency. And when you're outsourcing with any type of third-party manager, and I'm somewhat, maybe I'm not objective, I'm somewhat biased because we're an SMA manager. We run separately managed accounts. That way, every financial advisor, and on behalf of each of their clients who can also see everything, are able to look at every single trade that we execute. So I think transparency is really, really important. This isn't a commentary on closed-end funds or ETFs. I run an ETF, so I'm not saying it's the worst thing in the world. But closed-end funds sometimes are problematic because they promise a yield that sometimes doesn't come from option premiums. And to me, it's what you said perfectly. If we can't explain it, if we can't understand it, we probably shouldn't invest in it.
A very, very diplomatic answer, Kevin.
It wasn't easy, but thanks, Joe.
All right, I'm going to throw a slide up. So my apologies to podcast listeners, but I thought this was a compelling way to get to nerd out for a minute on what payouts might look like. Would you please walk us through what we're looking at on this slide?
Yeah, well, let me first say, if you're a podcast listener, you have a far bigger advantage. Yes, you're missing this slide, but you also don't have to see me. So I think, there's a tremendous trade-off there to your benefit. What we're looking at here, Jay, is an illustration of how we conceptualize option premiums from an income perspective. Now, we utilize them for, I think, more risk reduction than cash flow. Cash flow is the byproduct of it, which is very, very powerful right now because interest rates are very close to zero. So even a modest income stream is a powerful comparison to a short-term fixed income vehicle. Different risk spectrums, but I'm just thinking clearly in terms of cash flow and numbers. When we build a portfolio, we look for dividend payers, we look for dividend growers. We have a large cap core portfolio. We think dividends are very, very important for cash flow. So if we can generate 2 to 3% from traditional dividends, that in and of itself is very powerful considering where rates are. But adding a covered call component to it, and we're very tactical. This isn't a systematic process. We don't write options on every position every month. But on average, we can get enough covered calls written to generate another 2 to 4% per year. So that between the dividends and the option premiums, we can have a projected cash flow of 5 to 7% a year. And to me, for a baby boomer, someone that's looking for cash flow and income, and who can stomach and have the risk tolerance for equities, that is a very, very appealing cash flow.
Without a doubt. Kevin, remind me what the tax implications are for the premiums.
Yeah, I purposely didn't give you that in my questions, Jay.
Is that?
I would say that. Well, there's a catch to.
That's not something we should talk about.
Yeah, no, it's very, very important. Covered calls, the way we use them on a short-term basis, are taxed as ordinary income. So it's taxed at the highest rate, short-term capital gains. And for a lot of financial advisors, they kind of stop right there and think, well, I'm only going to use covered calls in a qualified account. If the idea of using covered calls comes up at all, which I know it will as a result of this great podcast, but prior to today, that isn't something that happens as frequently as you'd think. But if we talk about the 2 to 4% of option premiums being subject to that short-term capital gain, and I'm not giving tax advice, and we're not trying to go crazy here with tax suggestions, but for a lot of folks, dividends are treated as qualified dividends at a qualified rate, so they tend to balance out a little bit, not for everyone. The real tax inefficiency with a covered call strategy can come from turnover. So if we have a year like 2013, 2017, last year, 2019, I know it seems like a lifetime ago, but when we have those big, strong, robust markets, we're going to see more positions called away than we would in a year where we're down or flat or choppy. So from a cost-conscious perspective, a tax cost-conscious perspective, all things being equal, financial advisors may want to look at qualified accounts before non-qualified accounts, but we're split almost down the middle. Half of our accounts are qualified and half are non-qualified.
Yeah. So listen, I don't think investment decisions should ever be made through a tax lens, but through tax consideration. And
you never met my uncle.
So, does he do your taxes?
No, paying tax on for any reason would be just an insane concept. It is far better to lose money than pay a penny to the government. So if you're a financial advisor and if my uncle is your client or someone like that, don't show them a covered call strategy. But for most people, to your point, Jay, you don't want the tax tail to wag the dog. And there are certainly instances at the end of a calendar year where you can do some tax loss harvesting with separate account managers. And again, I think that the place for covered calls in an SMA as opposed to a packaged product has some advantages from that perspective.
All right, Kevin, let's wrap up talking about your process and how you and your team go about selecting the securities. You guys call it the EDI process. What does that stand for?
It stands for the Enhanced Dividend Income Portfolio, Jay.
Mm-hmm.
And the concept that we always think about is very old school. Ben Graham, Warren Buffett, show us great companies that take great care of their shareholders. We want the strongest balance sheets. We want the best free cash flow. We want companies that increase dividends because they're increasing earnings. So you'll find that our portfolio will have somewhere between 23 to 26 high quality blue chip names, companies that your clients are going to have good familiarity with, which doesn't make it a good investment, but I think it helps when you're opening up your financial statement and you've got some recognition that, hey, these are companies that have been around for a while. We are recording this in April of 2020. Some companies won't be, but we feel like ours have tremendous staying power. We feel like they're really the highest caliber investments, and we don't do anything differently because it's April of 2020. We buy those same types of investments through that same process, whether markets are up, down, or sideways. We want to generate 2 to 3% from those dividends. We want 15 to 20%, 13 to 15% dividend growth over 5 years, so that you're getting an increase in your cash flow. And then we utilize covered calls very tactically. When volatility is higher, we'll try to generate more call premium. In December of last year, again, lifetime ago, we had 0 covered calls written. This past Friday, which was option expiration for April, we had 14 covered calls. We had over 70% of our names covered. And we're trying to do that so that we can help to buffer some of that downside in volatile and down markets. Because really, that's why we utilize options. That's why we write covered calls. And I'll leave you with the Ben Graham commentary, which is, the best portfolio managers focusing on managing risk and downside. They don't focus on returns or upside. And if you can focus on controlling risk, the upside will very frequently take care of itself.
Yeah. Well said. Kevin, where can listeners find out more information about you, your firm, and your offerings?
Well, I think our website, Jay, is probably the best resource. It's www.capitalwealthplanning.com. I'm sorry it's so long, but we started it a long time ago and didn't really know that much about the internet or the fact that you'd have to type that really long name every single time you search for it. So take the time. It's worth it. It's a phenomenal website.
Excellent. Kevin, thanks so much for coming on and sharing your expertise on covered call writing strategies.
Thanks, Jay. Thanks for having me.